Are Tesla's profits collateral damage in the burgeoning EV price wars? Tesla has slashed prices for its models in the US by up to 25% this year as it looks to maintain its edge in the increasingly competitive EV market. The Elon Musk-led company slashed prices twice in the month of April alone and has reduced prices in other key geographic markets, including Europe and Asia. Here's IBD News editor Ed Carson.
Tesla is cutting prices because demand was not keeping up with its big production increases. And it's as simple as that.
The average sticker price for a Tesla was around $46,000 in the first quarter of 2023. That's down from roughly $52,000 in the same time period last year. Carson says that while price decreases initially lifted sales, there's now more cars being made than there are buyers. And the demand problem will only intensify as Tesla's newly opened Shanghai and Berlin factories ramp up production.
Deliveries hit a record in the first quarter, but they had to slash prices in order to do that because the backlogs are largely gone. Their margins have come down quite a bit. Sort of these abnormal COVID era profit margins are sort of going away. It's becoming sort of a normal automaker now.
How has Tesla's pricing strategy eaten at those margins? Gross margins fell roughly 10 points to 19.3% versus the same quarter in 2022. Our sister company, the Wall Street Journal, reports that Tesla's operating margin, which is an important measure of profitability, fell to 11.4% this year from 19.2% in 2022. Now, Tesla still has one of the highest operating margins in the industry. Ford's operating margin was around 4% last year, while GM's hovered near 7%. But Tesla may have a tougher time trying to absorb price cuts in the near term. Ford and GM can cover the loss in gross margins on their EV models thanks to their traditional car business.
What they're doing is sort of the opposite strategy. Instead of cutting prices, for the most part, they are keeping production reined in.
Carson says production for legacy automakers is still well below normal levels thanks to the pandemic and chip shortage.
They seem to be keeping production relatively low so their prices can stay high.
Tesla plans to remain aggressive on its pricing strategy, but investors are concerned that the popular car company might not be able to maintain its pace of growth without more cuts.
We've taken a view that pushing for higher volumes and a larger fleet is the right choice here versus a lower volume and higher margin.
That's Tesla's CEO Elon Musk on the company's April 19th earnings call. He says lower prices now can help Tesla reap huge profits when it attains full self-driving capabilities.
We do believe we're laying the groundwork here, and then it's better to ship a large number of cars at a lower margin and subsequently harvest that margin in the future as we perfect autonomy. This is an extremely important point.